we're going to roll this right into 5 presentations from some of the Fintech 250. These are some of the best Fintech companies chosen in a purely data-driven way because we, of course, at CB Insights are data geeks. So how were these companies chosen? How do we know that they're the best Fintech companies? Well, we used our National Science Foundation-backed Mosaic predictive health scores. Some of the things that go into this, I'll make this very quick because I don't want to bore you with all the data science, but in that Mosaic score, there are 3 M's: money, market, and momentum. Money. How much money have these companies raised? Who have they raised it from? Right? $1 raised from Google Ventures is worth a lot more to your company's health than $1 raised from Jonathan McKenna. So how recently have you raised that money? Those are the types of things that go into the money score. The second M, the market score. So if you are in a hot market, that's a good sign for you as a company. What makes a hot market? So what are the investors investing into that market? What does the exit landscape look like in the market? What is the news of that market? And what is the sentiment of that news? So really hard stuff that we're doing. Things like, in that market, what's the exit landscape look like? All those types of things go into the market score. And then the momentum score for these private companies. So what are these non-traditional signals that signal a private company health? What is their web traffic statistics? What are their SEO statistics? Right? What are their jobs? What are they hiring? What do their hiring trends look like? How are they trending on Facebook and Twitter? And what is the sentiment there? How are they trending in regular media? What is the sentiment there? All those types of things go into the overall Mosaic score. That was a lot of data science very quickly. The Cliff Notes version is what we're doing is really hard. And we're figuring out who those best Fintech companies are. So these companies, 5 of them, they're going to have 6 minutes, 20 slides. So this is going to move really, really quick. They are back there right now furiously trying to pack years of company vision into 6 minutes. So let's go ahead and welcome up Eddie Lim from Point Digital Finance.
Hi, my name is Eddie Lim. I'm the co-founder and CEO of Point. Point is helping homeowners change how they buy and finance their homes. Before we dive into that, a little background on how Point came about. So I've been fortunate to start some great companies, 3 of which have been acquired by public companies. And I've learned a lot of valuable lessons along the way. I've also learned what to do after an acquisition. So after my last company's acquisition, the first thing I did was take my family to ice cream. So when you embark on a startup journey, it's helpful to have a supportive team, both at home and at the office. After we got our fill of ice cream, the next thing on my to-do list was to refinance my mortgage. Interest rates were lower. I was ready to embark on my new startup. So it was an ideal time for me to lower my interest rate and reduce my monthly payments. Easy, right? Well, it turns out it wasn't so easy. Despite having a healthy personal balance sheet and a lot of equity in my home, I was denied my refinance. I was in between jobs, in between starting companies, no W-2 income, a family that consumes a lot of ice cream, and I was in the penalty box, too much risk. And that's when I realized that the banks don't know how to evaluate my risk. It's important to understand when money changes hands, that's effectively a form of risk packaging, right? Whether it's mortgages, credit cards, or even venture capital. And when risk is mispriced, as it was in our case, that's when new opportunities like Point emerge. In the housing market, risk is packaged purely as debt. If you have too much risk, like I did, then you might not get a loan or might be too expensive. If the risk is packaged incorrectly, then you have big problems. Taken to an extreme, in 2008, we had a massive over-leveraging of our economy, right? A massive overextension of housing credit. At Point, we believe that to deleverage and to stabilize the housing economy, you need equity, right? And if you think about it, I can sell equity in my startup. I can buy and sell Apple and Google shares. I can buy equity in commercial real estate. But why can't I sell equity in the biggest asset that I own, the biggest asset that most of you probably own, our homes, right? And that's the big opportunity that Point is taking on. So meet Charlie. Charlie and his wife have a son with special needs. They came to us at a point where they had strong income, significant home equity wealth, but were cash constrained by medical bills. So taking on more debt wasn't solving their problems. enter Point. We also care a lot about baby boomers and seniors. Nearly 2/3 of them own their homes outright, but only 30% have sufficiently funded their retirements. So Point's platform is enabling them to make smart financial decisions about unlocking that wealth trapped in their homes. On the other end of the age spectrum are home buyers and millennials who can't save quickly enough to afford their down payment. Point is helping them think differently about how to buy and finance their first homes. So for any great company, you have enemies, you have competitors. In our case, ours is quite formidable. It's accepted as a norm, it's sponsored by the government, and many of you probably have one. It's the 30-year fixed mortgage. Now, historically, homeownership was a binary construct. You either rented and own 0%, or you own and have 100%, or use a 30-year fix to bridge to 100%. But why not strive for 80% homeownership or 75%? That's where Point comes in. The last time mortgage innovation happened, it happened right here on Wall Street. Now, we need a new generation of companies to redefine home ownership and home equity financing. And we believe that equity will play a critical role in that disruption. Real estate and real estate finance are very big industries with very big incumbents. And Point, in contrast, is a market-shifting consumer finance product. It literally doesn't exist, so there's no playbook for what we're doing. And that means it's really important for us to have the right partners behind us, the right investors backing us, not only to educate our customers, but also to educate and to provide credibility to the broader ecosystem of real estate, mortgages, capital markets, and regulators. Now, it's important to remember that US housing is the absolute biggest asset class in the entire world. It's 29 trillion, 18 trillion of that is equity. And so if we can unlock even a fraction of that 18 trillion, we can distribute home price risk more broadly and provide diversification benefits for our homeowners and our investors. We've got a great team behind this. Privileged to have previous co-founders as well as previous colleagues working alongside them, as well as new faces and new perspectives to help us on this journey. So hopefully you have a much better idea of what Point is doing, why we need to exist, why homeowners need new ways to buy and finance their homes. So I'm thrilled to have shared this with you. And if you'd like to help or learn more, please email me at eddie@point.com. And thank you for having me.
Hello, I'm Greg Ott. I'm the president of NAV Technologies. We are a company that helps small businesses find financing and manage their credit. We're backed by Kleiner Perkins, Experian, Goldman Sachs, and a few others. And really what I want to talk about is how can Fintech save small businesses? I actually started getting interested in small business when I was running marketing for QuickBooks at Intuit. This is my house in Burlingame, California, going through a remodel. That's Gabby and Zoltan, my builders from Hungary. And they're great guys. They do a great job, love working with them. Unfortunately, the odds are really stacked against them, just like they are against all small businesses. We all know and love small businesses. We see the stats, 28 million small businesses in the United States. They drive so much of our GDP, drive so much of our employment. It's like a John Cougar Mellencamp song, you know, Little Pink Houses and Mom and Pop USA. Except small businesses really do struggle. In fact, the death rate of small businesses each year is about equal to the birth rate. Small businesses, technically speaking, are not thriving in America, and that's really a problem. In spite of a lot of discussion about what can we do, it really hasn't moved the needle. But that's what we're trying to do at NAV a bit. What really tends to hold them back, the biggest thing, is access to capital. They start out, they look for the money they need, but then they don't get it. And then they have to start cutting, letting Barb go. Very depressing, very sad. You know, small businesses, we always say they always remember the day they decided to go it alone. The sky was the limit. And then reality sets in. They don't know what to do, they have to cut costs, they skip payments, and it starts to become a bit of a downward spiral. If they miss a payment, now their credit score is hurt, their ability to raise capital is even further worsened. And it really becomes a struggle and a frustration for small businesses. The alternative financing landscape has helped. It's created some opportunities, but it's really become overwhelming for small businesses. Gabby and Zoltan are builders. They don't know any of these different types of financing. They don't realize there's over 44 different types of financing for a small business to go after. Which one's right for them? How much should they get? How long should their payment terms be? So what can Fintech do to help small businesses? There's 3 things we really look at to really help small businesses. The first is transparency, data transparency, helping small businesses understand how they are judged. Credit Karma has done a great job with this in the consumer space, as other people have, but no one's really done it for small businesses. In fact, we see that when small businesses do understand their credit profile, they're much more likely to get approved for the financing they're going after. That makes a big difference. The second thing that Fintech can do to really help small businesses is give them some basic insights. Mint did this pretty well for consumers in terms of understanding where your spending goes. But just telling them what's holding them back from getting the capital they need for their company, like credit utilization, or missed payment, or too many UCC filings. Pulling out those insights starts to solve that. Gabby and Zoltan can spend their time building their house. The third thing really is about removing friction and streamlining processes. Not only does that simplify the world, it eliminates cost. But that's really one of the problems when we talk to small businesses who need capital. They don't have time to go to a bank. It takes, on average, over 26 hours just to complete a financing for a small business. Gabby and Zoltan are too busy working on my house. I want to keep them there. So how do we do that? You help giving them a platform for smarter decisions. Help them understand their options and what they're really qualified for. Which financing is going to best meet their needs? And how do you make it simple for them? Create an easier path for them to choose what's going to be right for their small business. It's really about simplifying the world for small business. If Fintech focuses on small business as the customer, not only do small businesses start to win, but all of the ecosystem around small businesses win. So at NAV, we consider ourselves a bridge between small businesses and their financial institutions. We pull in the data for the small businesses and give them insights for free. And then as we collect that data, we use it to streamline the processes with all of their financial network. It starts with giving them what we call the Fitbit for their business. What is the financial health of their business? Both want their credit utilization as well as their cash flow, and other data sets that we can use to give them insights into how they're doing and what they need to pay attention to. And then it's about guiding them and simplifying their options. Based upon where they are and all the attributes of their business and what they're looking for, what is their best financing option for their business? Is it a credit card? Is it an alternative loan? Is it an SBA-backed loan? Simplifying those 44 different types of financing down into something that they can digest. And then one of the differences, I think, as Fintech and technology comes into financial services is really thinking about the customer from a lifetime value standpoint. How do you nurture and move along with them? That's where the data lets you do that. You can see and encourage them what's that next step on the maturity of their business. And that's what we try and do is give them recommendations and move forward with them. This is a quote from the Fed. Everybody talks about the key to helping small businesses is helping them access capital and make better financial decisions. Well, we always said doing it the same way as what people have done it in the past is really not going to unlock anything for small businesses. And that's where we think the timing is right now with really the solution for small business is a data solution. It's really about aggregating and using that data to help small businesses make better decisions, streamlining all their processes, and reducing costs for all their financial partners. So here's Gabby and Zoltan again. Hopefully they stay happy, they stay building. My house is almost done, as you can see. But what we like to believe is that with Fintech, we can help small businesses thrive. And when small businesses thrive, individuals thrive, communities thrive, and economies thrive. Thank you.
I'm Bobby Bose, CEO and co-founder of EasyTap, based in Bangalore, India. We provide a software platform to help businesses of all sizes handle every form of payments in this fast-growing country. Now, when you look at the payments ecosystem, it's had a phenomenal business model for a long time. Cards, devices, processing, banking services, all going through a single network controlled by the same players. Now, this space has been predicting disruption for a long, long time. We thought that technology would open up the market to new product companies. We thought that low margins would pressure the existing incumbents, maybe commoditization, maybe they would get bypassed. But the reality is it hasn't happened, because in developed markets, the system basically works. And the incumbents have spent decades building a lot of IP and homegrown systems, tribal knowledge to handle the complexities. But what if there was a market that wasn't working? What if there was one where the new players were not late to the party, but building the rails? What if the revenues and margins, the barriers to entry and the barriers to scale were all simultaneously going to zero? What would happen to every payments business that you know in terms of business model, IP, stock price? And what if there were companies that actually were launching and scaling in this hostile environment? What would that mean? Well, I am always careful when I talk to an audience like this, because two things. Number one, every entrepreneur thinks they're in the middle of some sort of massive disruption. And number two, the story I'm going to tell you is about India. It's a tantalizing country that people have been trying to figure out for a long time, but also have had difficulty getting their arms around. However, India is going through the disruption and digitization of everything. It's literally and figuratively going from 0 to 1. And in fact, I would say for financial services, we are in the middle of the inflection point that people have been waiting for. Infrastructure and core components are in place, and the flywheel is actually starting to move. And it will still get statistically significant very soon. Why am I so sure? Is because, number one, the government needs to transform this sector. Unlike other sectors which were focused on the middle class and disposable income, there are hundreds of millions of people that need to be brought online. It is the policy of this government, backed up by a huge amount of action over the last 3 years, to transform this space. And here's the thing, with a blank sheet of paper, a system that's failed the country, hundreds of millions of people off the grid, they must transform this. And it's happening as we speak. This also isn't a story about brute force and policy. There is investment in beautiful technology that is changing things and has been optimized for the mobile and software world we live in. In 2000, GPS was released by the US, and we got Uber and Google Maps. India has released 5, focused on identity and financial services. Now, all of that barriers to entry that we talked about with incumbents have been made obsolete overnight by the Indian government. And what's happened is a petri dish of chaotic, competitive companies. Digital instruments have reached mass market scale. UPI, an absolute alternative to MasterCard and Visa, has launched and reached massive numbers very, very quickly. You're seeing the flywheel starting to move, and when data magically comes online, we will be able to democratize credit and lending. And all of this has happened on barely what is 3G. 4G is going to kick in, and you'll see all of this accelerate very, very quickly. So let's go back to this original picture. And let's also add on the fact that credit has been inefficient, offline, and manual. The future of payments in India is going to be a software-driven business. You will see convergence of all of the different siloed technologies. They will be managed by a few software platforms sitting in the middle that interface with merchants and consumers and handshake with each other to manage every transaction. Data will be exposed cleanly through APIs to third parties. And that's what we've built at EasyTap. We do 3 things. Number one, we simplify payments. We've allow merchants of all sizes to handle every single thing that they want, the AWS of payments. We then wrap it up and allow them to integrate that to apps and make their businesses smarter. And finally, we allow them to unlock the data that's been, up until now, unavailable to them. The company is growing fast. We now process at $1.5 billion per annum and growing quickly. 1 million new consumers come onto our platform every month. And we handle the payments platforms for companies ranging from the largest enterprises to rural villages, doing financial inclusion to small and retail mom and pops. So this is a story. Investors sometimes are interested in India and want to learn what's happening, but why should non-investors care? Well, the story about migration usually is product innovation in the West moving to the East, maybe with a little bit of local flavor. But we're starting to see companies do what I talked about. In that domestic market where they're protected, they grow up and scale, and then they start taking their muscles and their business models and moving outward. Now, payments is very interesting. Yes, there are local integrations and compliance, but most of the companies who've handled it are used to it. It's very transferable. The technology and companies can stand up anywhere in the world. Is the future of payments potentially a system that's working today but might move to a completely different business model based on software tomorrow? It could. And it's not as far away or as difficult as you might think. Thank you.
My name's Ed Robinson, and I'm co-founder and president of Stash. Despite my accent, we're actually only about 20 blocks south of here. I wasn't told that it was doing 20 seconds per slide. So Stash's mission is basically, it's your financial life simplified. We're on a mission to provide the underserved access to education, guidance, and financial opportunity. This is something that we're really, really proud of, and something that we think a lot of work needs to go into it. So why are we doing this? There are too many Americans and people worldwide that aren't investing and not building wealth. We estimate about 79% of millennials don't invest and or are disengaged with financial services. That's an incredibly scary stat. The reason why most people don't invest is because of 3 reasons. So 1, it's confusing and unrelatable. 2, it's intimidating, and they don't know where to start. And the last part is it's expensive. They think they need a lot of money to get started. So how big is this untapped market? We look at users that have got less than $100,000 worth of assets. So that's about 63% of Gen Xers and 86% of millennials. That works out to about 109 million Americans. It's a totally untapped market. The reason why the incumbents aren't looking at this space and they're not really caring about it is that their business models and economics just don't stack up. Their median account value is around $273,000. Why would they want $5, $10, $20 accounts? We do. We want every one of them. We're changing the landscape through technology. We've built basically a scalable platform that allows people to start investing and start getting into the market with just your phone. We call it the Stash Way, and there are 4 tenets that we really pride ourselves on and what we really we work towards. 1, it's simplicity. 2, it's about education. Education is really key here. It's about automation, making it easy and making it habitual, and it's about advice. We're mobile first with a focus on simplicity. As you can see on these screenshots here, users can pick investments they believe in, investments they want, and investments they just care about. You can dive into these investments and get an understanding of the exposure, and then we wrap it together with education. Investing is about believing in the future, and so we've got investments on the platform that people really care about, things that people can start the conversation with. So for example, in robots or defending America, these are things that people believe in, things that people care about, and it spurs that conversation. And it gets people who have been sitting on the sidelines into the market. As you keep hearing me say, financial education is really core to our mission. And it's getting people to understand that time is of the essence. You need to start when you're young. And so we've got all of our content is built in-house. And we use the Stash Advisor, and this is an example of the Stash Advisor message that gives our users investment advice, gives them education, and also gives our users tips, guidance, and recommendations to build those right financial habits. And that's really one of the things that we're proud of. So let's talk about our timeline and milestones. We started in October 2015 with an iOS app. We launched in Android in April 2016. We're proud to say that we've just crossed over 800,000 opened brokerage accounts, and we just soft launched our retirement product. Now, if you look at our growth, the reason why we think we've been able to get such a steep adoption curve is 1, our speed of execution and the quality of our team, but it's also the fact that we're spurring that conversation. People are at bars now talking about colossal China and social media companies. So it's really, really exciting for us. We're really proud to announce that 86% of our users have got no prior investing experience and are just beginners. We're creating a whole new market. 68% of them millennials, average age is 29, and they're earning $49,000 a year on average. That's a great salary if you just go 20 miles west. Our users are in the Army, they're in the airlines, they're everyday, it's a cross-section of everyday Americans. They're in Walmart, the Lyft drivers. These people should have the same access that people that are wealthy. The thing that we really like is if you look at this, our cohort analysis here, and this is just users that signed up in different quarters since we launched. Each line is getting steeper, but each line's moving to the top right. It's showing that after 6 months, users have more than 4x their account size. So quickly in summary, we built a scalable financial services platform. We're handling over 800,000 brokerage accounts, and we processed over 10 million transactions already in the first 600 days. We're opening over 3,500 new accounts a day, and our content's being read by over 2 million Americans on a monthly basis. Our vision was to build a company on solid foundation of trust, simplicity, and authenticity. We started off with education, investing in advice. We're rolling out retirement right now, and we're really excited for the future because we're not stopping here. So if you guys are excited, I'm very excited. I've given everyone a $10 bonus if you want to try us out. Use the code Fintech 250. I might as well thought I'd put a little sales plug in there. Thanks very much.
Hello, everybody. No $10 bonus, unfortunately, sorry. My name is Gary Beasley. I'm the CEO and co-founder of Roofstock. I've spent the majority of my career at the intersection of real estate and technology, which has been a good place to be. I think technology tends not to embrace real estate, or maybe it's the other way around. It's been slow to innovate, so it's been a good place to build a career. This is my third real estate startup. The prior two have actually gone public, so I'm kind of hoping third time's not a charm here. Our mission is really to change the way real estate's bought and sold. So with our marketplace, you could buy leased single-family homes that have tenants in place already, and you buy them more like a stock or a bond. So our goal is really to break down the barriers, the geographic barriers of investing, and really separate operations from investing. It's a huge asset class. U.S. real estate market's the biggest asset class in the world, $30 trillion for housing. Where we're playing is the $3 trillion single-family rental sector. So that's about 16 million homes that have long-term tenants in them. The market, interestingly, tends to be relatively recession-proof, at least as it comes to rents. Even during the downturn, when prices dropped 30 or 35% nationally, single-family rental homes rent stayed flat or increased. So it actually created a nice yield opportunity, a nice entry point for investors. The returns are quite good. So you think about mid-single-digit unlevered yields, double-digit return on equity potential for the asset class, which comes about half from current yield and half from home price appreciation, which tends to be relatively steady over the long term. So the marketplace we're building, the goal is to really democratize it. So offer tools and information to individual investors, just like we had at prior platforms that were institutionalized. So we're squeezing out friction, squeezing out costs, compressing times, so we can really make the industry accessible. So what are the problems? For buyers, to buy a rental home today, you typically have to find a local broker, find a tenant, property manager, et cetera. And there's very little transparency. It's very hard to do unless you happen to live there. We solve that with some of our processes and technology. And for sellers, you typically have to vacate a home to sell it. The traditional MLS works quite well in many cases for vacant homes, not very well for leased homes. So we solve that. The overall cost to sell a leased home is often 10 to 12% by the time you vacate it, lose the rent, et cetera. It's about 2% using Roofstock. So ours is an end-to-end solution. So you start off research. We have a lot of different tools on our site. You can actually purchase the home in an e-commerce environment through our site, almost like you're buying a book. And then we help handle the back end for you as well through our certified property management partners. So how are we able to do this? It's really kind of a combination of things. We've got deep real estate expertise on our staff from the founding members on down. We're in Silicon Valley. We have a lot of technology that we're applying to solving the problems here, and then a lot of business processes and operations to make it all work effectively. We sort of turn the process on its head. So the diligence is all done up front. So if you go to our website, you actually see a diligence vault with inspection reports. You could take a 3D tour. Title work is in there. There's third-party valuations. So you actually do all that work on each home that you're looking at, and then you buy it after doing your diligence. We have a lot of different technology we're applying to this business. So this is static, but you can actually see an animated version of the homes on our site. And we use that with a little iPhone app on a robot that goes through the homes and strips out all the furniture. But then we have a lot of other cool tools that you could use to analyze the homes, build your portfolio. Another example is we've built our own neighborhood algorithm. Risk and return is oftentimes very hard to measure for real estate. So our data science team has constructed 1 to 5 star ratings across the country. And it factors in things like crime, schools, job growth, et cetera, and a number of other factors. We've also mapped all 16 million homes in the country, so we know who owns them, what we think they're worth, and what we think the rent is. So it helps us identify pockets of opportunity for our investors. And so there's a big data play to what we're doing here as well. So if you look at the traction we've gotten so far, our users have been quite engaged. About 5% of our registrants have bought a home so far, which I don't think is sustainable, but it's pretty good so far. And on average, they're buying nearly 2 homes per investor. So, and we're not spending very much on marketing yet, so it's been a pretty good start. Also, we're starting to see much better liquidity. So on average, or about 44% of our homes are selling within 15 days. When we first started, it was closer to 60 days. So as we get more and more liquidity on both sides of the marketplace, we expect to continue to compress the cycle times there. So last year, we did about $39 million of sales through our platform. We did about $42 million of sales through the platform in Q1. And we're on track to do about $500 million this year. Based on our pipeline that we have today, I feel very confident we'll exceed that number. And it's a combination of institutional and retail buyers. We're currently in 13 markets around the country. A lot of the usual suspects for investment homes. But we're also going into some Midwestern markets that have nice yield. So we're adding about a market a month right now and plan to continue to do that for the balance of the year. Our buyers have been coming from all over the world. So by breaking down the geographic barriers, you could be in Beijing or Boston buying homes in Florida with all the same information and data. And so that's something that's pretty revolutionary about what we're doing, not having to physically be in market and being able to buy with confidence. And then finally, we've built an app that's in beta right now, which we plan to roll out to as many investment homeowners as we can, gathering the data on their performance, providing tools and information back to the community to help them optimize their performance. And then for us, selfishly, that's the feeder for our future buyers and sellers, and also an ongoing recurring revenue stream. So thanks.